Home prices in the U.S. just hit $418,000, but foreclosure filings are up 20% this quarter alone. Is this the perfect storm or the next big opportunity? If you're waiting for the bottom, you might already be too late. Cash is king when markets crash, and right now, institutional funds are circling key metros like Atlanta and Las Vegas. In this video, I'll show you where the smart money is moving and how to position your portfolio before the rebound. Stay with me, because the next few minutes could define your 2025 playbook. Let's start by zooming in on where the U.S. housing market really stands right now. Current conditions, the calm before the shift. As of Q1 2025, the median U.S. home price has climbed to $418,000, according to Redfin. On the surface, that looks like resilience, but dig deeper, and a very different story emerges. CoreLogic reports that price growth has slowed dramatically, with forecasts dipping to just 2% year-over-year in 2025. In other words, the market hasn't collapsed, but it's losing altitude fast. Take a look at this chart. Median home price growth. U.S. National versus Sunbelt, 2023 to 2025. You'll see a stark deceleration in formerly hot regions like Phoenix, Austin, and Salt Lake City. Markets that saw double-digit growth in 2021 are now seeing 3 to 5% declines from their peaks. Meanwhile, supply is creeping up. Inventory has moved from 2.9 months in early 2023 to 3.5 months today, per NAR, and it's building faster in outer suburbs and overbuilt metros like Las Vegas and parts of Texas. What's causing the cracks? Affordability is the market's Achilles heel. According to Zillow, mortgage rates remain stubbornly high at 6.8%. While Redfin's affordability index shows buyers now need 40% more income than in 2020 to qualify for a mid-range home. That's locking out first-time buyers, and when new entrants vanish, liquidity dries up. On top of that, there's the golden handcuff problem. 86% of homeowners locked in rates below 6% per Freddie Mac. They're staying put, and listings are stagnant. This is why the market feels frozen, not falling. And here's something investors often overlook. Adjustable rate mortgages that were reset in late 2024 are now triggering a spike in delinquencies, up to 3.5% nationally, with hotspots in Nevada, Florida, and parts of Illinois per BlackRock. The ripple effects, regional shockwaves. Some cities are clearly feeling the weight more than others. Austin. Home values are down 5.1% year-over-year, while active listings have surged 18% since Q3 2024. Boise. Median prices have corrected 6% from peak, but rentals are holding steady due to remote worker demand. Las Vegas. Foreclosure filings are up 27% year-over-year, and investor activity is cooling after a 3-year buying spree. Take a look at this chart, U.S. foreclosure filings by metro. Q1 2023 versus Q1 2025. You'll notice the pattern. The over-leveraged boom towns are the ones softening first. Contrast that with the southeast markets like Charlotte, Atlanta, and Jacksonville, where prices are still holding firm and rental yields are rising. Where the smart money is moving. From what I've seen tracking institutional moves over the last 18 months, there's a quiet migration underway, from speculative price growth markets to cash flow-heavy regions. Vanguard and Blackstone are repositioning capital into the Sunbelt, not for capital gains, but for yield. According to Bloomberg, over 15% of all distressed sales in 2024 were scooped up by institutional funds, with Atlanta, Charlotte, and Tampa leading the way. Take a look at this chart. Top U.S. cities by institutional REO purchases, 2024. It's no coincidence these cities also offer rental yields north of 6.5% per Redfin. You know how this goes. When big money piles in quietly, it's a sign the smart money sees a rebound. What this means for cross-border investors. If you're based in the UK, Australia, or Canada, you're not just watching the US, you're watching the US dollar, tax treaties, and legal hurdles. Here's where it gets tactical. 1,031 exchanges, still available to US-based investors to defer capital gains. But if you're from Canada or the UK, watch for FIRPTA withholding, which can eat up 15% of your gross sale unless you reinvest quickly. CGT and currency arbitrage. For Australian and Canadian investors, buying in USD while local currencies are weak adds a layer of risk, but it also magnifies gains when repatriating returns. LLC versus trust structures. More international investors are shifting to Delaware or Wyoming LLCs for privacy and estate planning advantages. Talk to your legal team. Structures matter now more than ever. Later in this video, I'll break down 3 U.S. cities offering the best distressed property deals right now, including one where rental yields have quietly hit 7.2% and institutional buyers haven't arrived yet. But before that, let's talk about what to actually do if you're sitting on cash in 2025. Actionable investment strategies for 2025. Here's how I'd deploy $3 million to $10 million in dry capital across a portfolio. 1. Target distressed suburbs of growth markets. Look beyond the city core. Northwest Atlanta, East Charlotte, and Pasco County near Tampa are all showing elevated listings and seller concessions. 2. Rent first, exit later. Secure properties with 5 to 7% net rental yield, hold for 24 to 36 months, then revalue as prices recover into 2026 to 2027. This is how institutional REITs are structuring their returns right now. 3. Stack debt and cash smartly. If you're financing, leverage private debt at 6 to 6.5%, but back it with 50 to 60% equity to remain liquid. Alternatively, deploy cash for speed and discount access. Zillow reports cash buyers are consistently winning bids under asking in Q1 2025. 4. Build flexibility into your exit plan. Given election year volatility and potential rate cuts, keep at least 25% of your portfolio uncommitted to pivot if needed. Coming up, in the next section, I'll show you a case study from Invitation Homes, a US-based REIT that acquired over 2,000 homes at a 12% discount, and what you can learn from how they timed their entry. And before we wrap up, I want to leave you with one last strategy that's proving effective for investors in 2025, even in this declining market. It's what I call pre-positioning for the liquidity snapback. We're already seeing early signs that inventory is building just as buyer demand begins to stir, particularly in secondary metros with solid rental fundamentals. Take a look at this chart: housing inventory versus buyer demand, US 2024 to 2025. Notice how in markets like Tampa, Indianapolis, and Raleigh, inventory is starting to outpace current buyer activity, but not for long. From what I've personally seen working with investors in these cities, the ones who are lining up deals now, before the spring rate cuts, are securing properties at 10 to 12% below asking. Once rates dip or Fed forward guidance softens, competition is going to flood back in. You know how fast things move in this market. Waiting too long can cost you the spread, the yield, and ultimately, the deal. Let's quickly recap what we've covered. First, foreclosure filings are rising, and while it's not 2008, there's enough distress to create serious buying windows. Second, institutional capital is already repositioning, especially into high-yield rentals in the Sun Belt. Third, smart investors are using 1031's FIRPTA-aware structures and cash discounts to maximize leverage and minimize tax drag. And finally, timing matters. The best entries are rarely obvious when they're available. Acting now means you can lock in yield before prices rebound and capital flows accelerate. Delaying? That's a strategy too, but often a costly one. Now I want to hear from you. Which U.S. housing market do you think has the strongest upside in 2025? Are you already active or still sitting on the sidelines waiting for a bigger correction? Let me know in the comments below. And if you don't want to miss the next wave of profitable real estate opportunities, whether in the US, UK, Australia, or Canada, hit that subscribe button now. Like this video if you found it valuable, and share it with anyone serious about strategic investing in US real estate. This is EstateScope. Real insight, real strategy, no fluff. See you in the next one.